Welcome to the Deep Dive. Today we are tearing into the Q3 2025 earnings call for a real bellwether in the home improvement space. The results dropped pre-market on November 19th. And if you follow this sector, you know it's been a really tricky time.
It really has. You've got high interest rates, homeowners who are locked in place, and just generally cautious consumers.
Exactly. But despite that whole high-stakes backdrop, the stock surged. It was up over 4% on the day on huge volume.
Yeah, and that reaction, it's not just about a small beat. I mean, it signals a massive validation of their long-term strategy. The big-ticket projects are supposed to be soft.
Right.
So our mission today is to really cut through that macro noise and pinpoint the operational discipline and the strategic moves that drove that powerful signal.
Okay, let's start with the hard numbers that got everyone so excited. The bottom line performance was really robust.
It was. Adjusted diluted earnings per share, or EPS, came in at $3.06.
$3.06. And that's a pretty solid increase year over year.
It is. A powerful 5.9% increase. And, more importantly, it comfortably beat the consensus, which was sitting down around $2.95, $2.97.
So that 3% beat, that's kind of the smoking gun. It concerns their whole efficiency push is actually working.
Right. But while the bottom line impressed, the top line, well, that told a story a little closer to what people were expecting. Net sales were at $20.8 billion.
Which is a 3% increase year over year. So basically in line.
Basically in line. But if you really want to understand the quality of that revenue, you have to look at comparable sales, comps. They came in at plus 0.4%.
Okay, so a sub 1% comp. At first glance, that might sound a little underwhelming.
It might, until you realize the context.
Yeah.
Management was super clear on this. They were cycling a really serious operational headwind, about 100 basis points worth.
100 basis points. From what?
It was caused by the overlap of demand from last year, specifically all that immediate repair and replacement buying that happened right after those big hurricanes.
Ah, right. So to get a positive comp while you're up against that comparison,
Yeah.
that's actually a huge operational win.
It absolutely is. It suggests they're gaining underlying market share, which is offsetting that cyclical pressure.
So if we break that comp down, what really stands out is the customer mix.
And this speaks directly to their strategy. So the average ticket size grew 3.4%.
Okay, a nice jump.
A very nice jump. And it was driven fundamentally by the strength of their pro customer. Big project-based purchases.
But that had to offset something else, right?
It did. It was necessary to offset a 3% decline in comparable transactions. So what that means is simple. The small ticket do-it-yourself customer is pulling back a bit.
But the professional builder, the one who buys big and buys often, they're more than making up for that slowdown.
That's the pivot point for this entire story.
Let's unpack that. Let's talk about the core of their success here. Margin resilience. How did they pull off a 50 basis point increase in gross margin and a 10 basis point improvement in operating margin in this environment?
Well, the key insight here isn't just generic cost cutting. It's AI-fueled surgical efficiency. They leaned on two main levers.
Okay.
First, their perpetual productivity initiatives, or PPI. And this isn't just about trimming fat. This is about actively redesigning their supply chain, their store ops, to permanently lower their cost of goods.
So that's the structural cost reduction.
Right.
But what about the innovation side of things?
That's where technology meets inventory. They saw better credit revenue, which always helps, but the big thing was a really successful sell-through from their SKU rationalization efforts.
So getting rid of less productive inventory from the shelves.
Exactly. And historically, that creates a risk of shrink, of loss. But they managed it, and they did it with the help of these advanced AI inventory solutions. The margin expansion proves that AI is systematically improving their sell-through and driving down losses.
And that efficiency is what's fueling their whole total home strategy.
Yeah.
That's where the long-term gains are coming from. So the pro and services pivot, where are the biggest payoffs?
The pro segment is still the engine. Management confirmed that about 75% of their small and medium pros are still confident in their job prospects. Their backlogs are stable.
So the professional customer is still feeling pretty good.
They are. They're kind of insulated from that rate lock effect because they're renovating existing homes that, just need work, regardless of what interest rates are doing.
And their ability to reach that customer online is becoming critical. We saw, 11.4% growth online?
11.4%, yeah. driven by both traffic and conversion. And what's fascinating there is their closed marketplace platform.
A move to expand what they offer without actually taking on the inventory risk themselves.
It's a huge move, and it's already exceeding their expectations, both for getting sellers on board and for the financials. But the real game changer is fixing a huge pain point for customers.
Which is?
The ability to return marketplace items in store. I mean, think about it. If you can order a specialized tool from a third-party seller on their site and know you can just drop it off at your local store.
Without the hassle of shipping it back. Yeah, that removes a major friction point. That builds loyalty.
It really does.
And it's not just products. Their home services installation business is really hitting its stride. Double-digit comp growth in things like windows, doors, HVAC.
Kitchen and bath, water heaters, yeah. It's because they did a wholesale digital transformation of how they go to market. They moved away from this fragmented analog process.
You mean whiteboards and binders for tracking quotes?
Literally. They moved all of that onto a single tech-enabled platform with central selling.
And that must have a dramatic impact on the customer experience.
Absolutely. I mean, it used to take multiple visits, days of waiting to get a quote. By centralizing it, they've dramatically shortened that whole quote-to-install cycle.
Which lets them just grab market share, especially in needs-based replacement categories.
It's not about discretionary remodeling. It's about the 20-year-old water heater that just broke. And you can't forget appliances either. 4 straight quarters of comp and unit growth.
Right. Leveraging that next-day delivery and install capability, which they have in pretty much every U.S. zip code, that speed is a huge weapon.
It really is.
Okay, so this brings us to the elephant in the room, the acquisition strategy. They closed the $8.8 billion acquisition of Foundation Building Materials, FBM.
And they're still integrating Artisan Design Group, ADG. This is an enormous long-term bet that instantly deepens their exposure to commercial and residential builder supply.
So we're talking drywall, ceilings, the real basics.
Exactly. It is the anchor of their professional platform growth. But, the market needs to be clear about the short-term cost here.
And what's that?
Management was very transparent. These acquisitions are expected to dilute operating margins by about 50 basis points a year until the synergies really ramp up.
50 basis points, and that's coming from higher interest expense from the deal and just the investment needed for integration, right?
Right. That dilution is the cost of admission for this strategic shift.
But what's the immediate practical use of owning FBM? Why was this so necessary right now?
It's all about fulfillment and location. They're immediately integrating FBM's catalog into what they're calling the Pro Extended Aisle.
Which is designed to what?
To enhance fulfillment for huge, complex job site orders, especially in dense urban markets like the Northeast or California. FBM already has the physical yards, the specialty delivery fleets. They can handle bulk drywall way more efficiently than a standard retail store ever could.
They're basically buying the capacity to serve the pro customer everywhere.
That's exactly it.
Let's circle back to technology, because this feels like what truly separates them from being just a traditional retailer. I mean, the enterprise-scale adoption of generative AI, it sounds like a real competitive advantage.
They are operating at a scale that very few retailers can match. I mean, their virtual assistants, Milo and Milo Companion, they're answering nearly 1 million questions every single month.
1 million a month. And what's the tangible result of that for an investor?
It's incredible. When customers engage with the Milo Assistant online, the conversion rate more than doubles.
It doubles?
Yeah.
Wow. That is an insane ROI on a tech investment. What about in the stores?
The in-store version, Milo Companion, it's used for everything from looking up product details to training. And when associates use it, customer satisfaction scores go up by 200 basis points.
200 basis points is a huge jump.
It's a massive jump. They're in the elite tier of AI adoption globally. I mean, this isn't some pilot program. This is core infrastructure that's driving real productivity.
Okay, let's pivot to the forward-looking stuff, the investor context. Let's start with the macro environment and their guidance.
Right.
Management called the near term uncertain, but then they raised their sales guidance. That's a mixed signal.
It is mixed, but their diagnosis of the macro situation is key. They're cautiously optimistic on 2026.
Cautiously optimistic.
The near-term pressure is that lock-in effect, which is actually weirdly favorable to them in the long run. Homeowners don't want to give up their sub 3% mortgage rates, so they just stay put.
So they aren't moving, but they still have to spend money on their homes.
Exactly. The leaky roof still needs fixing. The 20-year-old HVAC has to be replaced. And that mandatory spending is funded by this enormous pool of home equity.
$33 trillion of it, I think they said?
Something like that, with about 11 to 13 trillion of that being tappable equity, so people can use HEOSEs for renovation funding. It provides a really reliable floor for their business, even if housing turnover stalls out.
And they saw improving trends in November, which is a good forward indicator.
A very strong one.
Okay, let's clarify the nuance in the full-year outlook that seemed to confuse some analysts. They raised sales guidance to about $86 billion, which is above consensus. But adjusted EPS guidance was tightened to around $12.25. That's the low end of their prior range and a little below what the street wanted. So better sales, but a lower profit range. Why?
It's purely about their investment priorities. That revised, slightly lower EPS guidance, it explicitly includes 20 basis points of margin dilution in this fiscal year, just from the FBM and ADG deals.
So management is basically signaling we're building our pro platform now, even if it costs us a bit on near-term profit.
That's it, unequivocally. They are investing for future market share gains.
And that long-term focus has some immediate consequences for the balance sheet. After financing FBM, their adjusted net debt to EBITDA is at 3.36x.
Right, and that means the focus now is squarely on integration and deleveraging. They need to get back to their target of 2.75x.
Which they expect to hit by mid-2027. So what does that mean for capital allocation for buybacks?
It means share repurchases are effectively paused. They're off the table until they get that debt number down, but they're confident they can do it through strong operating cash flow.
Okay, so that really clarifies the operational health and the strategic priorities. Let's move to our final segment. This is not financial advice. We're going to pitch an aggressive, outrageous but plausible trade idea based on what we've just talked about.
And the whole thesis for this trade hinges on what management called the $50 billion coiled spring effect.
$50 billion.
$50 billion of delayed or deferred big-ticket projects that are just sitting there waiting for lower borrowing costs. The market, we think, is undervaluing what happens when that demand gets unlocked.
So the deferred demand plus the structural share gains they're already making in pro and services. That's the potential catalyst.
That's the explosive cocktail. If the macro shifts in their favor, the stock could re-rate dramatically. Current expectations are for, flat comps.
Basically nothing.
Right. But if lower rates make ELOCs more attractive, and we've already seen average rates drop from 10 or 12% down to the 8 to 10% range, that $50 billion starts to flow.
So the trade isn't really a bet on the economy recovering. It's a bet on the Fed making it cheap enough for people to finally do those renovation projects.
Precisely. So the outrageous but plausible idea is an aggressive directional bet centered on their 2026 guidance acceleration.
And you're targeting the stock price inflection point tied specifically to the February 2026 earnings call.
That's the critical timing. That's when we expect formal 2026 guidance. If the operational gains from the Pro platform and the AI efficiency really come through, and you see any sign of macro normalization,
then that guidance will validate this whole multi-year narrative.
And it could cause comp acceleration way beyond what anyone is expecting right now, leading to a massive re-rating of the stock.
Okay, so the recap. The core takeaway here is crystal clear. This company is successfully pulling off a major strategic pivot toward a pro and services anchored platform.
Yeah, and you can see it in the margin expansion driven by that surgical efficiency and in the real tangible share gains they're getting in high-value categories, even during this really tough macro period.
They are strategically taking a hit on margins now to secure future growth.
They are. And the question you, as a listener, should track closely is the core long-term risk-reward of this whole FBM ADG integration. I mean, is the market right to look past the short-term EPS dilution?
Betting that this investment will solidify a multi-year advantage in pro and commercial services.
Or does the integration risk in what's still a choppy housing market present a real overhang? That deleveraging timeline, getting back to that 2.75x debt target by mid-2027, that's going to tell us everything we need to know.